You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Today's topic I thought would be helpful is regarding surrender charges. A lot of times people come to me and they have a contract existing already, and they're not sure if they want to move it over or asking if they can move the funds over to a new contract. That is called replacing. That would be replacing a policy. And we want to make sure that it's for a good reason or that it's a good idea, because not all policies necessarily should be replaced. Even if you have a policy that you think isn't working for you or helping you to begin the infinite banking concept, sometimes there's still good policies to keep in force. For example, one thing you might consider is if you have an older term policy. Term definitely, you can visually see very easily, it goes up with your age. All life insurance goes up as you age, but term is pure cost. And so you can definitely see the increase as you age. And sometimes it's a good idea to keep that term in force, even if you're beginning the infinite banking concept with a whole life policy. Sometimes you want to keep that term in force because we're always minimizing the death benefit within a whole life policy, or we most often are. And so that way it will help you to have enough coverage. Because if you want to get rid of that term policy and your new whole life policy has a low death benefit, well, we might want to keep that term policy in force. So I get asked from time to time, should I replace this contract? Are there going to be surrender charges if I replace this contract? So term contracts, from any of them that I've seen, don't have surrender charges. I can't blanket statement anything because, of course, I can't be 100% sure of all companies. But generally, I would say term doesn't come with surrender charges. You just have to call and terminate the contract if that's something you want to do. Now, when it comes to whole life contracts, none of the companies that I work with or have spoken to charge surrender charges. Again, I can't blanket statement the whole industry, but in general, I believe that whole life does not have surrender charges. Maybe some older contracts do that I haven't come across, but I would say typically they do not. They do not have surrender charges. It's universal life that generally has surrender charges. So far, every universal life policy that I have seen does come with surrender charges. Regular universal life, index universal life, variable universal life, they all come with surrender charges. Okay, so back to the whole life. So if you start a whole life and say 3 years later, you decide to close it, well, of course, I would say that's a terrible idea. Don't do that. Or don't open a policy with the intention of closing it soon or with the thought that you might have to close it soon. If you're thinking you might have to close your policy in the beginning years, I would say under your 10 years, I would say just don't start it. And actually more than 10 years. This is a long-term strategy. You're really going to want to hold on to it your whole life as it gets better with age 100%. But if you did have a policy and you decided in 3 years, oh, I need to close this, maybe something happened, you can't afford it, something tragic, and so you think, I need to close this policy, well, you're not going to get back dollar for dollar every single thing you've put into it. And so you might see that as a surrender charge, but it's not actually called a surrender charge. It simply means that you did not recover all the money back because some of that money was used to buy life insurance. And so that money went to the cost of life insurance. And so you're not going to have all that money back if you were to close your policy. But that's because those funds were served for a purpose to cover your family during that time period while you have the policy in case you were to pass away. However, even though you do not get back dollar for dollar, those funds that you put into your policy, in my example, year 3, if you were to say have to close your policy, maybe year 7, year 8, year 9, by that point, you're likely to be able to receive back all the dollars that you've paid into the contract if you were to need to close it. Of course, there are way better options if you needed to simply stop paying, but you could leave it in force and let it keep growing. That is an option, usually after year 7. So you would want to look at your options rather than just close the whole thing down because there could be something that's going to be way better than having to close it. So by year 7, 8, or 9, you're likely to have access to all the dollars or almost all the dollars that you've paid into the contract by that point. As compared to a universal life contract, they have surrender charges that go much longer than that usually. I would say I've seen surrender charge years last anywhere from 12 years to 20 years. And so that means there's an actual charge that they are going to charge you if you close your account or move the money to another policy, that there's going to be this fee that they're going to charge. Now, this surrender charge fee does decrease starting from year 1. Year 1 is the highest, and every year thereafter, it decreases a little bit until there are no more surrender charges. But of course, if you're thinking of moving money or rolling it over into a whole life contract or a different contract, you don't want to have to pay any fees, right? You'd like to be able to move all of your money if you could. It's a bummer to have to pay those fees. Maybe your cash value account says $20,000, but if you were to close the account or roll the money to another type of account, you would only be able to move $8,000 or take as a distribution $8,000 to yourself. And so we want to avoid having to have these major losses in surrender charges anytime you might be considering moving a policy's cash value or closing a policy. It's something you want to be sure you know what those charges are or if you have any charges before you make that action. Now, some index universal life contracts and possibly variable life contracts have the option for a rider that will allow you access to more cash in the beginning years. Because that's another thing. A lot of people are either talking about these index universal life policies or they're out there talking about IBC. Some are combining the two. But on older index universal life contracts, or IULs for short, they didn't have these access to as much cash in the beginning. So it was even more obvious why you wouldn't want to use that type of contract for the purpose of infinite banking. However, then companies started to roll out this rider that would allow access to more cash value so that maybe for the purpose of that, I'm not sure, or they just knew people wanted to be able to have access to more cash right away. In any event, the rider is available on different contracts with different companies. I can't say every company, but still, with all the people I've come across who have sent me their contracts so that I can see what they have and understand it better, I haven't seen an IUL yet that has this rider where they have access to a ton of cash in those beginning years. So I don't know if that many advisors or agents out there are using that rider. You definitely all know how I feel about using IULs for IBC. I think whole life is the right vehicle for sure, and so does the Nelson Nash Institute for Infinite Banking Practitioners, the founder really of this concept, infinite banking, and the first one to author a book about this for all of us to learn. So, if you happen to have universal life or universal life policy, and you're thinking that you would like to move it to a whole life policy, you'd like to replace that policy and move those funds, roll them into a whole life policy, you really should look into if you have surrender charges and what they are, because there are some things that can be done to get you started in whole life and making that policy more of a focus. So we can begin a policy, make that the focus, and then the focus of your banking process while keeping you from losing money to surrender charges if you feel like you want to get rid of or get out of an existing policy, whatever that policy might be. Again, if it's a whole life policy and for some reason it makes sense to move those funds, it's not likely to have any surrender charges. If you see a balance, you're likely able to move that whole balance to a new contract if that's what you would like to do. It's the universal life ones that I have less confidence in the balance being available to you fully because of the surrender charge. And you may have to refer to your actual contract to see the surrender charge schedule to make sure that when it will end, because any statements that you receive may not have that information on the statement. As always, I'm happy to help you, work with you. I'm happy to review current policies if you feel like this is something you want to do, the infinite banking concept, and you would like to work together. I'll be perfectly honest. If it's one that I think is still good, that will only get better with age and is well seasoned and will serve you well, I will absolutely tell you so. Or if it's a term policy that I think we should still keep, it really depends on how your plan rolls out. Whatever makes the most sense for you for death benefit to cover your family, for your dollars so that we can focus them in the best place to help your cash and your wealth grow the best we can. As I mentioned, I don't usually replace whole life because these policies only get better with time and we can't go back in time. Although I did help a client recently who wanted to replace his current existing whole life contract with a contract at the same company. So I looked into it. I thought, oh, there's no way this is going to be better for you. The contract is 10 years old or 14 years old. I can't remember exactly how many years, but it was an older contract. And I said, usually it's always better the longer you have it. So I can't imagine that it's a good idea to replace this. But he was way more interested in the loan rate because the loan rate on his current contract was a variable loan rate. At that time, it was 5.85%. And the newer contract would give him the option of a fixed loan rate at 4%. And so that's really all he could see. He just wanted to lock in that lower interest rate. So I looked into it. I built a new contract, a current whole life contract, and illustrated moving the money over. And I was totally surprised to see that the death benefit actually was slightly higher and the cash value was projected to grow well because this newer contract had a higher dividend schedule or higher projected dividends. And so, anyhow, it worked out really well for this person because he wanted to replace. And I was thinking it's with the same company. You already have a good contract, season's always better. But then it wasn't. It worked out really great for him. He was insurable. We were able to move that money over, and he got that locked in lower interest rate and a higher death benefit. It was pretty awesome. Okay, everyone. Well, thank you for listening. I hope that that was helpful to you to help clear up some confusion maybe regarding surrender charges. If you're ready to rock and roll with the infinite banking concept and you'd like to work with me, feel free to reach out to me at Valerie at alphaomegawealth.com. Thanks so much. Have a great week.